Hello and welcome to Shares Expert Eye. In this edition of Expert Eye, we're talking to three leading experts about SIPs and the benefits of such a product for pension provision. Let me introduce Andy Parsons, Head of Investment Research at the Share Centre.
Hello.
Charles Galbraith, Managing Director at Bell Youinvest.
Hello.
And Francis Moore, Managing Director at European Pensions.
Hello.
Francis, for those new to SIPs, what's the advantage of having one over, say, a stakeholder pension?
Simply, they're two different products. A stakeholder pension is designed to be very simple, relatively cheap, although many are charged on a valorum basis, a percentage of charges basis, whereas a SIP typically is charged on a flat fee basis. There can be variations between the two. But essentially, in order to stay within the original prescribed charges base for stakeholder pension, the investments that you can hold within the stakeholder are typically very limited to index trackers, for instance. Whereas within a SIP, certainly from the rule changes that took place back in 2005, any investment is pretty much allowed, but there are tax consequences. For instance, if you were to try and invest in, say, well, some are prohibited, like yachts and vintage cars, but others, like works of art, effectively are taxed almost out of existence. Right. So those are the changes. So one is very simple, very suitable, a bit like our auto-enrollment discussions as well, in terms of, again, trying to open up pension provision as widely as we possibly can across the population. But inherently, they're very simple. As funds grow, then for those that can accept the risk, wish to take the risk, then there's the opportunity of opening up into wider investments. And that is where the SIP is the preeminent vehicle.
Andy, Francis touched on just a few assets that could go into a SIP. Perhaps you could expand, perhaps give us a short list of some of the things that could go in and things that are perhaps potentially excluded as well.
Well, there's a broad breadth, as Francis already alluded to, and I think most people would be looking at, generally start off with things like equities or shares, as they may be, other people may know them, funds, unit trusts, OICs, you've got exchange traded products, you've got investment trusts, you've got derivatives, you've got contracts for differences, you've got commercial property can go into it. There's quite a varied list, but as Francis already alluded to, there are certain other elements which are a little bit more difficult and incur a charge, should they...
Absolutely. And I think, what one's got to look at is sometimes there's symbiosis between the pension scheme and, for instance, an employer. Yeah. So the opportunity through commercial property for the pension scheme to hold maybe the principal operating office of the employer can be very, very helpful, particularly in these times since 2008, where we've seen very restricted bank lending. The pension fund has that opportunity of acquiring an asset, providing cash flow into the company. And the added advantage within commercial property of being able to gear the portfolio up to 50% of the fund. So again, with all these things, flexibility brings complications and regulations, etc. So, it isn't to say that a SIP is the panacea for everybody, but certainly to have in your tool chest that opportunity of being able to move into different asset classes, perhaps into asset classes that are not following the herd. But again, we have to make warnings about, going into areas like private company shares. There's been difficulties in the industry over what we call UCITS investments, unlisted collective investment schemes. It's more than just buyer beware. You really need to know your stuff, and unfortunately some people can drift from the safe and secure to less secure. But that's not to say that it doesn't give great opportunity for growth, but you need to always balance risk and reward.
We talked about some quite complicated instruments and ways of investing in SIPs. Obviously the easiest route is funds and stocks and shares and bonds. Is that the simplest route, do you think, for people to get into when they start a SIP? Is something very simple, understandable?
Yeah, well, I don't know how simple those are. I think what they are is instruments that have been successful in the past. they're also instruments, shares and bonds and funds, as you said, are investments that people use in other forms, or in ISAs, yes, or in let's say dealing accounts or whatever. They're easy to understand. They're easy to track. They've clearly got risks that if you've got in shares, they can go down, but they haven't got some of the other complications that we mentioned earlier. There's lots of information about them. They're reported in the newspapers, on the television, and on a lot of the platforms that we see emerging now. There's lots and lots of information about shares and funds that you can get very easily, and they become more understandable, and therefore, to my mind, a very sensible investment.
And transparent. Well, we talked a little bit about unlisted securities which aren't transparent. You really don't know whereas clearly funds and stocks you can see. The government's reduced its lifetime allowance, starting in April 2014. The government tends to twiddle around with tax regulations and rules. What can a saver or do in this sort of circumstances?
It's interesting. Prior to the budget that we've just had, I think that question would have caused a certain amount of sort of anger and annoyance, because the government has fiddled around so much over the last few years with allowances, and it destabilises what is an excellent product. As you say, the lifetime allowance is falling from next year from 1.5 million to 1.25 million. Investors can protect themselves against that. There are two forms in which you can do that. They need to get a move on, because with one of them, you need to do it before the end of this tax year. And again, go onto the providers' websites. There's lots of information on there. With the actual allowance of how much you're allowed to put in every year, that's also fallen from £50,000 to £40,000 for next year. You can go back 3 years, so there's a bit of protection there. And so I think prior to this last budget, I would have said, please stop fiddling. I think they have thought about it a little bit, and whilst those two allowances aren't changing, there are certain other elements following the budget which is going to, perhaps not exactly transform, but make SIPs even more interesting than they are in any case, and that is fantastic. Looking forward, do I think there's still risks if another government was to come in? Well, the two big risks are probably the tax-free lump sum that you can get out, and also the tax that you get on putting money into a SIP. Do I think another government would attack? It would be interesting to see what my colleagues think would do. Do I think another government would attack the tax-free lump sum? Probably not, because everyone understands, everyone knows it. Might they be attracted at reducing the tax that you get back on it? Possibly. I don't think this government will, but a new government might.
You don't think it'll be something for next year, prior to the election, that they tinker with again just to get some more?
I don't think this one will. But we'll have to see
on their side.
Yeah, we'll have to see. But it'll be interesting to see, what my colleagues say on those.
Well, certainly in terms of people needing to protect their lifetime allowances, probably the best way of achieving that is actually to make sure that you go online with HMRC, because you will get an immediate receipt for doing that. Because one of the gotchas that we can just help the audience with is that if it goes in paper form, there's no automatic receipt. So have you got it or haven't you got it? So that's just a little tip on the way. In terms of the lifetime allowance, I think there's always going to be a balance in terms of where the government sees things. And one of the issues that's coming up that they're trying to ameliorate through the levels of protection, but also announced today, is that there are some significant changes coming from the 27th of March, with cap drawdown being increased to 150%. And from 2015, there's going to be a consultation in terms of effectively allowing a more flexible approach to taking pensions income, but being taxed not at 55%, but at either a sort of progressive basic rate tax of 20 or 45%. So we're also seeing some other technical changes in that flexible drawdown is actually being reduced in terms of the amount, and around the areas of very small pension pots. This is going to be a really growing problem, particularly with auto-enrolment, people changing jobs, etc. what to do with small pots. And the Pensions Minister, Stephen Webb, has got the Pots Follow Member initiative. But what the government has been announcing today is changes around what is technically called triviality, i.e. very small pots. And there's been an overall allowance, which was at 18,000, which, for those of us remember, was 1% of the £1.8 million original limit. So, gosh, hadn't that all changed? So that's going to go up to 30,000. So that's going to take a lot of administration out of small pots. Yeah. The other one is the very small pension pots, where there was an allowance of £2,000 per arrangement up to £6,000 for 2 arrangements. That's now being increased and will allow up to 3 pots, and I believe that's going up to £10,000. So I think actually what's quite interesting is that the government actually today sounds as if it's actually starting to listen to savers' worries about this constant erosion. Although we're seeing a lot of change today, I think these are very positive measures to give savers much more flexibility in the way that they start taking their retirement income.
And anything you want to add,
Well, I think one thing that people need to appreciate is that we talk about some of these allowances, but those allowances, whilst they may have been coming down, are still very, very high for a vast amount of people, because sadly we've been in a world where people haven't really worried about saving for their retirement. And therefore, for a big nucleus of people, those limits may seem very high and out of reach. But if you can start saving earlier, if you can make your investment as soon as you can afford to put something away, then that compounding effect. And I think as an industry, what everybody needs to do is make things simply easier for them. And therefore, starting for children, you can have pensions for children. So many people do not appreciate that a child can have a pension. They can start saving at a young age. And therefore, but also, if you're unsure about some of the investments that can go into it, go onto some of these, go onto websites where they may run practice accounts. So, you may understand how an equity works, but some of the more hybrid or more esoteric type investments, start to see how they react when markets move, so you start to understand how they work. And if you feel comfortable with them, then maybe you may wish to put them into your pension and start doing. So you can start to put in what you understand, and then start to look at other investment types, should you so wish, should you wish to have a greater degree of risk. But the earlier you can start, the better your off you will be.
Yeah, I think the other point on that is that the government, as we've touched on a couple of times, have made quite a few changes. I think what we do need now is stability. Clearly, they make a change which is favourable. We're all delighted, but one of the slight issues I've got is that I think investors get a bit confused. What is the allowance this year? What was it last year? How is it going to impact me? Oh my God, I've got these forms to fill in. And it gets confusing. And if they get confused, then they might run away. And that's really what we don't want. And so I think if we can try, if the government, and I think if they are beginning to listen, let's hope they are, can think about that, have some stability, don't see it as a nest egg to be stolen from. I think that will help the whole industry hugely, because it will allow people just to understand, right, I know what that means. Very, very important.
So try and leave allowances in place and the tax treatment. Obviously we want better tax treatment for SIPs, but
yes.
not too often maybe let people stay. Well, we've seen with ISAs and the recent budget announcement, increasing allowances, changing the format of it. It's perhaps sometimes just good just to stop for a little while. Francis, how can an investor check that the SIP provider is financially safe and up to the job?
Well, I think there's 2 aspects. There's obviously the operating company, but very often these SIPs are actually written under trust and actually have trustees. So you need to look at what level of engagement the trustee is actually having over the running of the scheme, combined with the scheme administrator. So it's not all necessarily about the operating company. But on the other hand, it's very important to make sure that they're sound. Look at Companies House. Look since SIPs are personal pensions, then they're regulated by the Financial Conduct Authority. So go and have a look on the Financial Conduct Authority site. Also, look at things like blogs. SIPs can be very complex. I mean, you may find sometimes there's some uncharitable comments.
Oh, yeah.
That will happen as many as there are glowing comments. But try and look through them, because there are complexities, and sometimes they're not always as fully understood. And I think, again, as an industry, we need to do more to try and to explain to consumers.
Charles, we're talking about financial security of the provider. How important is that to somebody looking for long-term pension planning?
I mean, it's absolutely essential, because obviously if you went with a provider that then went bust, your assets are probably going to be protected, but you don't really want to be in that position. You need to go and find another provider. So that is one element of the due diligence that a new investor should do. Is the company I'm going to be doing my business with up for it? Is it doing well? Is it in a position that it's making money? Because ultimately that is what we do want as investors. The price is important, but it's not the ultimate. What other things should you be looking for? I think on the SIP world, we'd be looking around service levels. Can that company, has it got a good reputation? It's extremely important. Has the company got a good reputation for offering the services that it does? I'm talking in particular here around the sort of the SIPs where you can invest non-exotic things, so shares and funds and bonds and cash and stuff like that. What else is important? When you get to retirement, what are the options? And again, the budget will have changed some of those elements, but again, not all providers are totally flexible as to what they allow you to do. So as we get near that stage, that's incredibly important. And obviously price at the end of the day.
Fees are so important, aren't they?
Fees are important over that long period of time. I think you've got a website yourself, DIY Investor.
Thank you again for the plug on this one. Yes, we have indeed, where you can go in and compare the SIP providers and how much you're going to pay and transfer fees as well. That's on DIYinvestor.co.uk. That's a good plug. And the providers here are generally on there. But you're talking about fees. With RDR, there's more transparency generally about fees. What would a typical person opening a SIP or transferring?
Well, I think opening a simple, if I can call it a simple, we don't feel they're simple, but if they haven't got all the exotic stuff in them, so it's sort of shares and funds, I think you would expect a sort of wrapper charge a bit more than you'd pay for an ISA, so maybe £100, £200, something like that. You then have to pay for your dealing,
yes,
£10, something like that. The funds, they're sort of two models appearing. Either it's a sort of flat rate for them, alternatively there'll be ad valorem, and again that which one is good for you depends on probably the size of your portfolio. All these things are very, very individualised, and it's important that you think about it. I think compared to a few years ago, they're sort of good value, I think. Certainly there's quite a lot of work that gets done in the background, quite a lot of administration that needs to be done, and that does need to be paid for. You need to watch your charges, because in particular as time goes on, as we've said, they can become quite a large proportion of the assets. So it's worth spending a bit of time getting someone who suits you on that side.
Clearly in a SIP you shouldn't be over trading, it's there for a longer term approach, but if somebody did want to sort of trade quite regularly in a SIP, do you have a scheme where it's a little bit cheaper the more you trade? Or?
Yes, I mean quite us included, quite a lot of the providers have got schemes for sort of frequent dealers where the charges may be half, maybe £5 or £4 for a deal, and clearly for people who are trading quite a lot, and some of them do like doing it, then they will benefit from that lower rate.
I would endorse everything that's been said there. I think you have to be very wary nowadays of flat fee or simple flat fee versus ad valorem, because this is an investment, as we're talking about, that is your retirement savings, and therefore the longevity, the compounding effect, particularly if you start off, let's say you are you're very rational and you start off in the early 20s, which would be great, or even as a junior, the compounding effect, if you're on an ad valorem fee, will be over time will be absolutely astronomical. So you're looking for flat fee, and again, ourselves at Shezza, we have a frequent trading tariff for the dealing, and therefore, and it always comes down to understanding how often you wish to trade and what type of investments you're going to look at. And so you've got to look at all this, and then in terms of the customer service, have a look on the websites, have a look for the award recognition. See whether they've got those emblems from those brochures and those magazines out there that may publish, and those online surveys where you get recognised. And this helps formulate a view. You know, if I ring up, will I be able to talk to someone who understands the nature of my query? What do they offer me as additional online services? You know, do I have to pay for newsletters or magazines or research, or is it available at my fingertips for no additional cost?
Again, it's not sort of price wars necessarily. Prices are very similar. It's just content.
It's
and
content.
Customer services generally. What about European pensions management? You know, your pricing structure.
Well, we've always been flat rate because essentially over long periods of time, as we're saying, percentage charges, however trivial they might seem, really do erode the ultimate value. So it's very important. And typically, because pension funds over periods of time, the sizes of them get quite substantial. So a percentage of a very substantial sum, you know, if you take even just a simple amount, £100,000, 1% doesn't sound an awful lot. But if I told you I'd like a cheque for £1,000, suddenly it brings it home as to actually how much you could be paying. So it is very important to ensure that charges are kept reasonable. We ourselves, I mean, we're not just one platform. We actually service, I think, with SIP's 6 platforms. So we allow people that opportunity to go and actually harvest greater opportunity because they, you know, certain platforms are more specialist in certain areas than others. So it's always coming back to this trade-off, making sure that service is preeminent.
And financial security, which we talked about earlier, making sure the company's going to be there when you actually retire.
Because it is going to be over a long time. And I think increasingly, one of the tests that consumers need to be asking themselves is, how is this company going to support me when I come to the important decisions around retirement? As an industry, we are woeful. We have to do a great deal more, and I'm sure, you know, this is going to be part of an ongoing debate as we go forwards. But certainly in terms of education, one of our problems with this long-term industry, the pensions industry, is it's all about compound interest. And people find maths and compound interest in particular a real challenge.
Yes.
And we've got to somehow find ways of making that much more palatable, making them understand what the choices are.
It's education, really.
It is completely about
providers
education.
need to have an education there on their websites to help understand.
You know, I would say one of the big changes maybe over the last 5 years has been, if you've looked at possibly all our websites 5 years ago and compared them to today, that's where there's been quite a lot of change. Some providers have been there for longer, and I don't see that stopping. There's going to be more and more. We need to educate in particular, because I think there's a wider range of people coming into the market. Maybe people in the past who were looked after by advisors and they're no longer are being looked after by advisors. Either they think they can do it themselves, they might make mistakes. We've got a responsibility to try and help them and give them that education, give them some information that will help make good decisions and not bad decisions. And that will continue, which is important and perfect, really.
Clearly, as a magazine, that's what we hope to do, is you provide that education to people about not just to SIPs and ISAs, but generally about investing. And one of our strategies now is to try and get that education onto third-party websites, you know, media and other brokers, so that people get sort of an education right across the whole spectrum of investment strategies, really.
I think accessibility to advice is going to be absolutely crucial in the forthcoming decades. And I think because of things like RDR, which was a sort of, I suppose, as an industry thing, is a bit technical, because it was all about actually changing situations where advice was given against commissions from investments. That's now been cut, and it's now organised on a fee basis, and that's good news. That is very good news. But we've got to build on that now, and it's going to be all about not allowing parts of our consumer base to get disenfranchised from advice, but I think the whole advice piece is going to become a bit more transient, and people will go to websites, will satisfy themselves, but they may still want to actually go face to face on an important moment, and one of those moments is going to be around retirement.
Andy, we're next going to talk about ISAs. We've got another video on Expert Eye, which we talked about ISAs in a bit more detail and some of the benefits, or not benefits over a SIP. Can you perhaps briefly explain when you should use a SIP, not an ISA, and vice versa, where perhaps an ISA would be appropriate, or part of your strategy have an ISA as your pension provision?
Well, I think first and foremost, harnessing the two together and building them together for a good retirement strategy is key. Now, the difference between the two fundamentally is the ISA has a lower investment limit per annum, but more importantly, you have the flexibility there of being able to sort of put your hand into the pocket and draw money out should you so wish. But you have to remember that there is only an annual limit. It's much, much lower. We're hearing today in legislation that it's going up to 15,000, which is fantastic. But also, at the end of it, all your gains are free of capital gains tax, but you are able to dip in and dip out. On the other side of the equation, the pension, the SIP for instance, you get the tax relief on your contributions when you go in. So the government will enhance your contribution when it goes in. And when you come to make that all-important decision, when do I retire, you can take currently, and I say currently, 25% of that as a tax-free cash lump sum. Now that's quite important to some people, but you have to remember you cannot dip in and out throughout the accumulation phase. And then of course the rest of it then has to be taken as some form of income, and you are taxed on that income as though it's your salary that you are earning from your current employer. So it is basically, you're basically employing yourself when you come to retire. You are being taxed on that income. So there is a decision to be made, but working the two together, harnessing the two together, gives you the flexibility to be able to go into the ISA, put some money in, but know you can get hold of it for a rainy day should you so wish. Whereas in the pension, you know it's in there for a set period of time, and you can't touch it until you make that all-important decision, I wish to retire.
Charles, have you got any thoughts about
ISAs
over SIP?
It is the obvious one, which is sort of linked, is try and do both.
Yes.
If you can.
Balanced portfolio.
If you can afford it, because they're both attractive, slightly, as has been said, slightly different benefits, but they're both very good products. And the main thing we should be doing is trying to encourage everyone to touch these things who've got some spare cash to save.
Clearly, Francis, you would say that we put more investment, you can put different assets into a SIP than you can into an ISA currently. Yes. The ISAs are changing as we talk, and some people would like to do commercial property and listed securities, and that obviously is another area for people to look at. Slightly riskier for some people, but it's an area to look at for investments.
Absolutely. I mean, this is one of the fundamental differences of a SIP compared to stakeholder, for instance, that we talked about earlier, is that you've got greater investment flexibility. Yeah. But it is about knowing and having confidence in those investment decisions, and not just, hearing about the latest investment wheeze down at the pub, or more these days on social media and other media, and sort of jumping into it without understanding the risks. Very, very important. Like, if you're doing shares like, your magazine, very important. Do research, understand, and don't step over the line until you are confident that you do understand.
That you know where you're going.
Yes.
Thank you all very much indeed for taking part, and we hope you've enjoyed this edition of Expert Eye.